Hey fam! Welcome to my brand new YouTube channel. Today I'm going to try to take on the Herculean task of explaining to you the ins and outs of the stock market. Just kidding, not the ins and outs, just the basics. The stock market! The stock market! The stock market! The stock market might be a subject you kind of have the feeling you should know more about, but it feels too late to ask. Don't worry, I'm here to unpack it for you. Investopedia says the stock market refers to the collection of markets and exchanges where regular activities of buying, selling, and issuance of shares of publicly held companies take place. The word stock seems to be a good 50% of the term stock market, so let's start there. What is a stock? Put simply, a stock or share represents a slice of a company, meaning that shareholders are part owners of any entity in which they own stocks. If I own 3 shares of Disney, then I am in fact a partial owner of Disney. But what does that mean to own 3 shares? How many shares are there floating around? Well, outstanding shares refer to the total number of shares owned by the entirety of a company's shareholders. Currently, Disney has about 1.8 billion outstanding shares, all owned by humble individuals and shadowy institutions alike. So I'm not trying to brag, but I own approximately 1.66666667 times 10 to the negative 9th percent of Disney. So you can just call me Mr. Moneybags. I'm a regular Scrooge McDuck over here, swimming in gold and wearing custom Yeezys on my webbed feet. Look at these Yeezys. What a steal! One of my financial literacy videos just needs to be me showing y'all where you can snag knockoff Yeezys for like $8 or whatever. Those 1.8 billion shares all added together get you Disney's market capitalization, or market cap, of 228.76 billion US dollars. Market cap is sort of a company's market value, and for the sake of simplicity, you can think of it that way, though a company's true market value is a bit too complex for the scope of this video. All right, so that's a stock. Now, how does the price get set? And how and why does the price change every second? The answer takes you back to your Econ 101 class. It's a simple case of supply and demand just happening in real time. Basically, millions of buyers and sellers are participating in a big ol' auction. I want to sell a share of Microsoft for $250, but everyone else is trying to sell for more around $230, and potential buyers are placing bids around $220. All of that informs the market price, and constant bids and asks, as they're called, influenced by things like quarterly returns, political changes, and a million other factors, all result in this squiggly graph. Let's demystify what placing a bid looks like and what placing an ask looks like. All right, time to buy some Ford Motor. And yes, I'm using Robinhood, which offers commission-free trading. I see that the Ford Motor price is about $773, $774, but I want to put in a limit price for $7.70. Essentially, a limit price is the highest price that I'm willing to buy this share of Ford Motor at. So if the market price goes down just a little bit, then the order will go through. Let's see how we do. All right, the order went through. Let's sell this baby. I'm again going to put in a limit order saying that the minimum price that I'm willing to sell Ford Motor at is $780. So if the market price goes up, then I will be a sweet 10 cents richer. So sorry to flex on you guys. I just can't wait for that dime to burn a hole in my pocket. One final clarification on this point. It is true that companies participate in stock buybacks and a few other situations in which they do purchase their own shares, but largely it's just regular Joes and a lot of rich Joes, so maybe less like regular Joes and more like fancy Josephs, buying and selling common stocks. So why buy stocks? The obvious answer is to make money so you can finally afford an on-brand Yeti. It's not worth it, by the way. But how exactly do you make money by trading? We've already been over how and why the price of a stock changes, so your goal is simple. Buy shares of companies you think will go up in value and sell them at a higher price at some nebulous time in the future, raking in those sweet, sweet capital gains. Buy 20 shares of Disney for $130 each, and in 50 years, sell them for $2,000 a piece after Disney has gone full on monopoly. The other way to earn money in the stock market, or hopefully in tandem with capital gains, is through dividends. Dividends are cold hard cash or additional shares, usually distributed on a quarterly basis from a company's earnings. There are pros and cons to this approach for the corporation issuing the dividends, but companies use dividends to entice investors to hold on to their stocks for the long term, rather than participating in something like day trading, buying at one point in the day and selling it at a later point in the day when the price has gone up. So why do companies make these shares available to the public for purchase in the first place? Imagine I own a business, let's say an online marketplace that sells toaster strudels. At first, I'm shipping out a strudel here and a strudel there to enthusiasts scattered across the country. But before I know it, the demand has gone through the roof for that flaky, flaky goodness. And I have to expand quickly to keep up with the demand of the ravenous public. But I don't have the money or capital to take on new staff or expand my infrastructure, or strudel structure, if you will. One way for me to get the cash I need to hire additional staff and buy a couple new warehouses would be for me to take out a loan. But loans accumulate interest and can get pretty expensive, and can actually be kind of hard for tech firms to secure. So another way for me to get cash in a hurry to get those things that I need to expand my business is to host an IPO, or initial public offering, at which point the public can purchase ownership in my new firm, Strudelacalypse. The stock symbol will be a pastry emoji. How's that for world building? And I know, I could have just called my strudel empire something obvious like strudels on or whatever, but I'm not going for that low-hanging fruit. I'm going for that random fruit that doesn't make any sense. So what does this all mean to you? Before I move on to the next section, I want to clarify that while I am going to teach you and encourage you to make money in the stock market in future videos, this video is just an explanation, not a recommendation to buy individual stocks. I certainly do, and maybe you should too, but not until you're maxing out your IRA or 401k, for example, which I'll go into detail about in an upcoming video, so don't worry if you don't know what those things are right now. It's important to buy shares in an educated, intentional manner, because investing in the stock market, particularly when buying individual shares, does carry risk. I'm covering the stock market first because it's crucial to understanding many of the other topics I'll cover, especially retirement accounts. With that out of the way, why should the health of the stock market matter to you? Well, if you're not already heavily bought in, then the answer is you probably already put too much emphasis on it, thanks to the way politicians and the media talk about it, as if it's shorthand for the American economy as a whole. Say it with me. The stock market is not the economy. The stock market is not the economy. Unless you're very rich and therefore likely already heavily invested, the health of the stock market matters a whole lot less than the national unemployment rate and wage stagnation. In fact, the wealthiest 10% owns a staggering 84% of all outstanding shares in the market. Now, with this channel, I'm very confident I'll close that gap, but let that sink in. When a president brags about a bull market, he's really just bragging about making his rich buddies richer, often while ignoring stagnant wages and almost definitely ignoring the mathematical inevitability of the ever-growing wealth gap without sufficient regulation. Think of it like this. Stagnating wages and exploitation of workers help contribute to a healthier bottom line or total profit for big corporations, and therefore better returns for shareholders. In other words, they can make more money by paying workers less. Makes sense. This illustrates a scenario where the well-being of workers, which make up the majority of our country, and yes, you're probably a worker unless your last name is Walton or Buffett, is actually at odds with the type of behavior that the market rewards. So if you're a blue-collar worker at a Trump rally applauding the bull market, you need to stop and think what you're cheering for. It would be wonderful if higher quarterly earnings for a corporation always translated to higher wages, and many politicians will imply falsely that it does. But that's not the world we live in. What's funny is it kind of used to be. The 3 decades following World War II, productivity grew by 97%, and wages grew accordingly by 91%. Not perfect, but pretty close. And guess what? This didn't stop us from competing on the world stage, or even prevent us from being the world's largest economy. Now, compare that to the wage growth from 1973 to 2013, where worker productivity increased 74.4%, and hourly compensation only increased an abysmal 9.2%. Woof! So why aren't wages going up even though profits are? The money is there. In 2014, Wall Street bankers were awarded double what all minimum wage workers made combined in bonuses. And in 2019, it was triple. Well, one big factor is the massive decrease in union membership. Just about all we have to fight against the influence and money of corporate USA is our numbers. And by we, I mean workers. Teaming up and using the negotiating power of unions clearly worked, so we must bring them back, along with other government protections for workers. Now, at this point, some of you might be wondering, but what about inflation? If wages are higher for everyone, then our dollar will be worth less. Pay the McDonald's cashier $15 an hour, and now my Big Mac is $1,000 or whatever. Essentially, this argument asserts that if wages are raised, then up the prices will go to account for this. Thus, all of this new spending money that we have burning a hole in our pockets isn't worth what it used to be, because life is just so much more expensive. So what's wrong with this oversimplified view of inflation and how it works? For one, wages are not even close to keeping up with inflation. Workers are being paid much less than they were in previous decades. So what this argument really claims is that we cannot afford to pay workers what they used to get paid at a time when our GDP was much lower, meaning there was less money to throw around. They want us to believe that something our country has already done is impossible. It's like if all of our grandparents grew up with unicorns as pets, and suddenly we came along and they said, unicorns don't exist, here's a mule. Oh, and if unicorns did exist, they would cause inflation. Then you go to their backyard and it's a straight up unicorn palace with more unicorns than ever. Give me my unicorn! As this 2018 Forbes article points out, companies are sitting on cash but not raising wages. So the argument that prices would have to be raised in response to higher wages also rings false. The money is out there, but without unions or government protection, there's just no incentive to pay workers fairly. Instead, they're happy to pay wages that will make paying off those student loans next to impossible. Or they're happy to pay the federal minimum wage if allowed, an income which guarantees that folks putting in an honest day's work will live below the poverty line. Call me old-fashioned, but I don't believe anyone who works a 40-hour week or more, as it often is, should be living in poverty. And the truth is they don't really have to. Pushes for workers' rights are always met by corporations and their political puppets disingenuously screaming about layoffs and inflation. But history and the facts tell a different story, even though they'll continue to regurgitate their scare tactics with a straight face. The ultra-wealthy want to act as if they cannot afford us, but the truth is, we as a society cannot afford the ultra-wealthy. But maybe I'm worried for nothing. How have we been doing in very recent years? Conservative-leaning Forbes points out the following. The Trump administration has turned what was an uphill battle for organized labor into an outright fight for survival, nominating pro-corporate judges that favor harmful arrangements like forced arbitration. I'll pause for a sec on the quote. Forced arbitration requires workers to resolve all disputes with their employer through arbitration rather than through the courts, which robs workers of one of the few protections they have. So, not good. Okay, quote continued. Stacking the National Labor Relations Board with anti-worker appointees and most recently nominating former Walmart lawyer and Wall Street darling Eugene Scalia to the role of Secretary of Labor. Let's pause and point out the obvious. Trump's self-imposed image of representing the common blue-collar worker is so counter to reality. It's like if wildfires claimed they stood for forest preservation. So what should your takeaway be? Well, I want you to buy into the stock market, as I'll explain in future videos, because it is true that the lack of financial education is a small part of the problem. But stop cheering for bull markets like it has anything but the tiniest impact on your life, and start pushing for unions to make a big comeback. If a politician brags about increased labor union participation or significantly increased wages under his or her leadership, then 90% of us have something to cheer about. And you can cheer a little bit about the stock market after I teach you to invest, I guess. Sorry guys, my cat's being really cute, so quick break to pet the cat.